There are some other mechanisms that they can do with dollars. So, for example, China, when they acquire a lot of dollars, they will often go out and make loans to the rest of the world. So instead of kind of reinvesting in U.S. capital markets, which they do to some extent, they'll also go out and contribute to the dollar funding that we see in the world, which ironically increases future demand for dollars because now all these entities have inflexible contracts that they have to try to pay back. And so we could see a shift in where some of those dollars go. We could see the trade deficit narrow to some degree. You could potentially reduce the trade deficit by 10, 20, maybe even 30%. So there'd be fewer dollars going out there. The risk would be that a lot, less of that would pour back into US markets, which would give us weaker asset price performance, which the Trump administration would not necessarily want, although they've signaled that that's a lower priority for them in this administration compared to the prior one. Bessent's comments the other day were, that for the next 4 years, it's Main Street's turn, not Wall Street. I just think that the challenge is that without addressing the core issue, it's going to be very hard to serve on a lot of those promises. So, the trade issue is one where because I've analyzed it for a number of years, I've been kind of saying that something eventually has to be done about it. So I think the administration's right to prioritize it. I think that was a mandate from the election. I think that's part of why the blue wall fell and became a red wall, essentially, in this election. So I fully get why they're tackling it. I just think that there's challenges there because they have to kind of go after some structural setups that have been in place for longer than either of us have been alive. One of the issues is there's a time mismatch. So the consequences of the tariffs hit right away, whereas some of the things that you're trying to structurally change can take years, or in some cases decades, but at least they start taking years from the beginning. So in order to bring a lot of that back to the US, you have to build more manufacturing facilities. You have to have tons of automation or skilled workers to run them. You generally have to have more energy infrastructure, which is often overlooked, which is that even if you run everything with robots and you don't even need people, you still need energy. And that's especially true for heavy industry like steel making, which is a priority for the administration. So you've got to rebuild or shift over energy assets, manufacturing facilities, the know-how that comes with it, reorganize all those supply chains. That's a multi-year thing. I mean, you're basically trying to, increase your industrial base by a set of trillion-dollar assets or more. And the other aspect is that the approach is kind of like if you're on a highway and you just pull the e-brake. If the whole world needs dollars and you want to quickly as possible stop the flow of dollars out into the world, then the system's going to seize up and it's going to have consequences both abroad, but then a lot of those consequences ripple back into the US. So if all these entities in the world have dollar liabilities, for example, and most of that's not even owed to US entities, it's often owed to other international entities. Well, a lot of them also have US assets. It's not always the same entities, but a lot of times it is the same entities, or at least in the same country. And so they can sell US assets to get the dollars that they need to meet their liabilities if their main source of getting those dollars is reduced or shut off. But so then you can get illiquid downward moves in US assets. And it could even be a situation like we saw during this sell-off where bonds aren't even necessarily a safe haven that they've historically been, because instead of a shift from stocks to bonds, it's an outright capital outflow, something you typically see in emerging markets when they have issues. So you get this kind of like emerging market light behavior in US markets. So I think, yeah, US markets are affected. And then because the US is so financialized, generally speaking, our tail can wag the dog, which is that if you get weak markets for a while, that can actually impact the US economy. And then in addition, of course, the tariffs themselves. If you have small businesses that are suddenly, their imported goods are tariffed, so they're paying more on the expense side, they can only push out prices so much so quickly, so their margins are squeezed, and they can't just flick a switch and say, well, we'll make that in the US now, because the capacity at scale doesn't necessarily exist. Maybe like around the margins, if you're making shirts in one country, you can make shirts in the US, but everyone can't do that because the infrastructure is not there and it takes time to do that over. So I do think that at major scale, particularly like the ones we've seen on China currently, are the ones that were threatened to the rest of the world, that of course can have really big impacts. So the long-term debt cycle kind of looks, especially in the US, but other developed countries, kind of looks to see how these really long-term debt accumulations build up and then get resolved. And the short version is that, generally speaking, debt accumulates in the private sector, eventually has a major crisis, and then there's kind of a shift where the sovereign level kind of bails it out, and a lot of that debt ends up on the sovereign level. And then there's really nowhere to go other than default or inflate it away, which is like a gradual kind of purchasing power default. And so they're currently in the phase where they've already had the private debt bubble peak, in my view. That was back in the global financial crisis. We're now, over 15 years into basically that's now on the sovereign level. They're running structurally big fiscal deficits, partially because of demographics reasons, partially because interest expense is no longer being offset by ever falling rates, and so these are issues now. The the Gordian knot, the thing that makes it so challenging to get out of that kind of fiscal tailspin, is that even if you do try austerity measures, which I'm not convinced that they're able to do yet, but even because the campaign promises were to protect Medicare, protect Social Security, if anything, boost military spending, those are the really big buckets of where money goes. And so the other mechanism is to try to raise taxes. The downside is that if you do it in a way that affects the market, and the market goes flat to down for a year or more, that can ricochet back into weaker tax receipts. And that's not true for every economy in the world. There are many other economies that are less financialized than the US. And so there are examples of, say, Germany or Canada being able to reduce their public debt burdens from similar levels that the US finds itself now. But the difference was that at the time they did it, they were less financialized economies. And even today, they still are to some degree. Whereas the US, if they try these austerity measures, which can include cutting spending or a massive tax increase, which is what the tariffs are, then that can have near-term effects on reducing the deficit. But then the year later, you get kind of a hangover from that because a lot of the compensation that's happening because of rising equity prices, of course, capital gains, other mechanisms are impaired. And so it takes a pretty big restructuring to actually tackle it, which is why I keep saying nothing stops this train, which is basically to say that from here into the 2030s, I view very low probability that they're going to meaningfully reduce the fiscal deficit, because that's kind of where they are in the long-term debt cycle, and the number of things they have to untie in order to address that are pretty significant. If we pick off a smaller country, especially one that's particularly reliant on US trade, then we of course would have a massive advantage in how we deal with them in negotiations. Like Mexico would be an example. Whereas when you have a rival power where you can't just flip to another country, like if we don't get coffee from country XYZ because we're angry at them now, we're in a trade war, we can get coffee from another country. There's no one country that we're just devastated if we can't get coffee from them. There are some other sources. Whereas you can't just say teleport China's industrial base anywhere else overnight. And so you can hurt them, but you can't replace them quickly with anyone else. So basically, it's like that problem of if you owe your bank, like $100, it's your problem. If you owe them $1 billion, it's the bank's problem. It's kind of like that with economic size, I would say, in terms of these industrial bases, supply chains, energy infrastructure, and all that stuff we previously discussed. And then, as you point out, there's an additional layer on top of that, which is to say that even if that struggle is in the US's favor, which I'm not sure it would be, but let's say it was, then the extra layer is, there's also the financial capacity, which is that these countries, many cases, are creditor nations. They've gotten those assets from decades or years or decades of structural trade surpluses. So they have a lot of financial assets that they can wield. And so, like we saw, even when stocks were going down, bonds were not going up. And it's a key kind of goal of the administration is to try to get the 10-year lower on a sustained basis and to get some of this interest expense under control. And so because we have these structural fiscal deficits, that gives us a vulnerability on the economic side as well. So our financial markets are one of our Achilles heels that especially really big creditor nations can go after. And I think we're seeing that. I think the administration is aware of that in the sense that that's why they're trying to build a coalition against China. One-on-one, it's not a bet you generally want to take. Whereas if you can make it 10 versus 1 or build an economic bloc around them, I'm not sure how successful that would be either, but I can see why they're trying it. I think we've also seen conflicting goals there, which is to say that some people are saying that, Besant's going to break the PBOC, the Bank of England, for example, which would basically be like in that case, a weaker currency, but that would only add fuel to the fire of how competitive that they are. I think if you take the smartest people in the administration and kind of get their honest views, my assumption is that they'd want something like a Mar-a-Lago Accord that basically come in and say, look, let's de-escalate, but you have to strengthen your currency somewhat, and we want to have, more neutral terms to kind of at least slow down some of these trade deficits and start the process of trying to balance this out better. I think the e-brake solution of trying to stop those deficits overnight is just implausible. But I think that if they were to kind of maybe steelman what they're trying to do in a 4-year term for their legacy and potentially future terms, is to at least start the process of rebalancing global trade, because it's inherently a long process. But this is the opening volley of negotiation, and we'll see how it goes. I'm not a political analyst; I'm more of a macro analyst, and so I can only rely on others to know the motivations other than just seeing the actions myself. So even this de-escalation is still a multi-$100 billion annual tax increase that hits right away, and can cause distress in pockets of the market. So I think we're seeing some price action today that is indicative that maybe we're not out of the woods financially or economically, just because there's been some degree of de-escalation. I think the prior uncertainty and the prior levels would have, of course, been even more impactful. As for whether they're inflationary or disinflationary, I would start with the kind of the premise that sustained higher inflation pretty much requires money supply growth in order to get that. So money supply growth doesn't necessarily lead to price increases, because it could all be offset by productivity gains. So if you double the money supply but you get way more efficient at making everything, you could have many things not go up in price. But in general, one of the necessary inputs for structural price increases is money supply growth, because otherwise it's got to come from somewhere else. And so I think that the opening volley here is some prices, especially ones that are now associated with China, are likely inflationary. Other products could be disinflationary because you can slow down the economy. And so the things that people need and they can't get elsewhere can go up in price. Other things they don't need or can get elsewhere can go down in price because demand is weaker. And then you can also get disinflation in asset prices, basically weaker asset price returns to fuel some of those consumptive patterns. And so I think it's the type of recession that if you get it, whether it's inflationary, would partially depend on what's happening on the fiscal side, partially what's happening on the Fed side. So if they go back to QE, increasing their balance sheet to support some of those fiscal deficits in the bond market in particular, if that were to happen, then that's how you get a stagflationary scenario, in my view, that you basically have higher tariffs on goods, less supply chains in disarray, combined with large monetized fiscal deficits. We're not there yet, but that's a scenario that's certainly on my radar.